I'm walking through every single segment of the economy, construction, apartments, residential, right? And I'm showing you how the largest banks, they're just manipulating the shit out of the data.
We live in a credit Potemkin village.
Correct. Yeah.
Meaning the delinquencies you see are not accurate, and even the modifications you see are not accurate because the rules have been changed.
Fake. Completely fake. Yes.
Today's episode of Monetary Matters is brought to you by VanEck's semiconductor ETFs. Later on, you'll hear more about the VanEck Semiconductor ETF, ticker SMH, the largest semiconductor ETF, and their newer VanEck Fabless Semiconductor ETF, ticker SMHX. Let's get into it. Today, I'm speaking to someone who I've been wanting to interview for a very long time. His name has been whispered about in the corners of credit world, bank world. I'm speaking with Bill Moreland of BankRegData. Bill, welcome to Monetary Matters.
Thank you, Jack. I appreciate the opportunity to get some time in front of your audience.
Bill, in bank world, which I'm a casual observer of, you have many measures of credit indicators, whether it's delinquencies or charge-offs, indicating that credit is actually easing. So credit stress is going down, delinquencies are going down. What do you make of that of that picture when you look at all of these big banks reporting their quarterly earnings and having their credit losses go down?
Look, this whole credit problem that we're having with delinquencies, and we are. But we can see that the delinquencies are starting to get better. Well, that's a myth. There's a lot of things going on behind the scenes that are driving the non-performing loan numbers appear to be inverting for a number of banks and improving. In some instances, that may entirely be true. For a lot of those banks, it's a manipulation of either note-on-note financing to get them off the balance sheet temporarily and non-depository financial institution funding of that, or it's doing enormous amounts of loan modifications at levels we've never done before, and then changing the rules around the loan modifications reporting so you don't see it. In some ways, the story is improving. In many ways, we're manipulating the way that we report data to drive numbers. And what I mean by that is it's an arcane subject in banking, but I'm not some guru. I'm a credit collections guy. I've managed credit and collections at Wells, American Express. I ran collection shops. I ran risk shops. I've done loan modifications. I know exactly how they work. I'm a fan of them, but it's like medicine in moderation, right? What you can do as a risk manager or collection manager is you can do a ton of loan modifications. These are unprecedented levels of loan modifications. And when we say loan modifications, Jack, what we mean is, hey, Jack, you owe us $10,000 a month on that little medical commercial real estate loan that you have for your medical office. I can't make it. All right. Well, you got to make it. Well, I can't. So I'm going to go bankrupt and you're going to get nothing, or we can negotiate. And so they lower it to $8,000. So when we say loan modification, the loan modification negotiation perspective is done is to keep you out of delinquency. The whole point behind it is to get Bill Moreland through a time frame that allows hopefully the recession or whatever downturn we're in to turn back up and the business to pick back up and hopefully not go delinquent, not go charge off. So it very much predicts failure. So if Bill Moreland is a cohort, and a lot of guys, small businesses like Bill Moreland, BankRegData, start to have stress in the system, one of the ways that you can mitigate that stress is to lower payments. And if you lower enough payments and you lower it by a substantial margin, what ends up happening is your delinquencies as an echo will start to get better. So are they better, or are we just providing the illusion that they're better? And one of the enormous significant changes after 4.5 decades, is the FDIC in the last couple of years, the regulators, the policymakers at the Fed, the OCC, the FDIC, FASB, the BPI, the Bank Policy Institute, they've changed the rules on how we report loan modifications, which makes getting a true picture of what is happening much more difficult.
So when I look at many big banks and small banks as well, for that matter, reporting lower delinquencies, lower charge-offs, you're saying that those big banks are actually moving those loans from delinquencies and they're modifying them before they go delinquent. Is that what you're saying?
Well, they could. Technically, you're not allowed to modify a loan if it's in delinquency. At least you weren't back in the 90s when I did it at Wells Fargo. And I'm a big fan of loan modifications. It's a tool in the toolkit. The problem you run into is it's a gateway drug. Once you step across a certain threshold, it becomes the de facto way. So please understand. I want the audience, the people watching, to understand loan modifications in moderation are a very good tool. It's when you get extreme. And so what's happening is we've got a lot of extreme loan modifications. So when we start modifying those loans at such a level that it gets beyond what a bank is reserving is allowance and loan loss reserves, right? Then your capacity to absorb losses. And modifications will solve a problem temporarily, but if you're not modifying good people, you're modifying people who are struggling. And if you know that that pool has an elevated charge-off risk, just by lowering the payment, that doesn't resolve the issue. What we found at Wells, at least in our population, was if we went in with a 2-year charge-off rate of in excess of 22%, modifying loans, they worked great for a year. But once you got into month 15, month 18, month 21, past that loan modification, your charge-off rate is 10, 12, 15%. So you're saving some of these borrowers and bringing them back into what I'd call a cured status or ability to make the payment. But your 2-year charge-off rate is still a considerable multiple of your base portfolio. So that's why the FDIC tracks loan modifications. It's part of the Texas ratio. It is the single biggest predictor of bank failures in the GFC. And I did provide, if at some point later, if you want to walk through and see what those numbers are, and it's pretty remarkable. So when we change the rules to life to date reporting, what we've done, view it as a Ferris wheel. And so if I get my payment modified, I get on the Ferris wheel, I'm making a lower payment. I just go around and I keep making my lower payment. I never get off. Well, what the policymakers did in 2023 Q1, right when commercial real estate was going up, and consumer delinquencies were going up, right when we started to have these huge delinquency credit issues, we changed the rules to you get on the Ferris wheel, you make 12 payments, you can get off the Ferris wheel. So as a risk manager, as a collection manager, if I just keep manipulating how many people at a steady stream are getting on that loan modification Ferris wheel over a course of 2-3 years, which we're now 2.5 years into this cycle, I could have modified 5, 6, 7, 8% of my loan book. And you as an observer from the outside would only ever see 1.5 to 2%. So when you see the delinquencies climb, and then the echo is in 2025, 2 years later, you start to see the delinquencies coming down. It's because people are getting on that loan modification Ferris wheel. And that is a very clever way of managing your delinquencies, but it doesn't solve the problem, right? If your 2-year charge-off rate is still elevated, you're resolving some of the delinquency issues. But if your 2-year charge-off rate is still a problem, what are we going to have in 2026, right? Or what are we going to have in 2027? But here's where the reporting change gets a little curious. I don't believe there's anything in the rules that disallow the ability for a bank to just modify a loan again. And I've specifically asked policymakers, hey, I'm a devious little guy because I've done this before. I couldn't write the rules better as Bill Moreland at 27 working at Wells Fargo doing this. But Bill Moreland at 27 at Wells Fargo would have said, sweet, once I get past that 12 months and that borrower gets off the Ferris wheel, if they go back into delinquency, I just lower their payment again. So theoretically, will we ever show delinquencies, right? And where a bank would see this is in their net interest margin, their loan yield. At some point, if they do this on enough of their book, their loan yields will start to go down. So there is a regulator, but right now we don't see it, right? We don't see it.
I think a lot of bank investors, myself included, we look at the quarterly earnings report, we look at presentations, we also look at the SEC filings, the 10Qs and the annual report, the 10K. I believe in the SEC filings, they do talk about loan modifications. To be honest, I really glazed over them until I started speaking with you. But in the presentations and in the quarterly earnings reports, I don't believe they really talk about those loan modifications at all. So I think there's a whole slew of bank investors, particularly like in passive indices and such, who have no idea what this is going on at all, right?
Right. Yeah, and you wouldn't know, right? So FASB made this change first. And it isn't FASB, it's the big banking lobby. And I provided a link to the BPI, the Bank Policy Institute, a little bit further down in the document I sent over. That basically it's the JPMorgans, it's the Goldman Sachs, it's the Wells Fargos, it's the Bank of Americas. Let's be honest, it's the biggest banks, right? So they started lobbying the FASB to change the rules. Now, why FASB would want to do this is beyond me. But I also am old enough to remember we had non-GAAP. There was no non-GAAP. There was no disallow this. I mean, when I went to grad school back in the early 90s, there was no such thing as non-GAAP, right? Or a one-off. But this is, FASB was the initiator behind this. And then what happened is, it's my understanding that they started to lean on the regulators, right? Because there becomes the honest reporting. So very subtly, as FASB changes the way they require banks to report loan modifications, and they just disappear. Loan modifications went from $72 billion at the end of 2022 to 19 billion. We wiped away $51 billion of collective knowledge about what banks were modifying. 33% of those were, or 33 billion of that was mortgages, which raises a whole bunch of questions. Why do we have $33 billion of modified mortgages in the greatest housing market of all time? They don't
Wait, sorry,
see.
modifications went down or up?
They went down, but they didn't go down. They disappeared. So instead of having a life to date Ferris wheel that gets bigger and bigger and bigger, they got the Ferris wheel. If you had your payment lowered and you made 12 consecutive payments, you can get off the Ferris wheel. So we went from $70 billion of loan modifications on the Ferris wheel to 19 billion. So they didn't raise the payments back on those guys. They're still having lowered payments, but our collective knowledge of this got removed, right? So if FASB's reporting one way and they change it and banks just start reporting lower, banks aren't going to say, this is what we used to report, but now the FASB's letting it, the Bank Policy Institute and FASB's allowing us to report lower. We're not going to report adjusted and real. We're going to report adjusted. But there was this tug of war between the OCC, the Fed, and the FDIC. It predicts failure. And we'll walk through this document in a second. I'll ask you to bring it up, but this is the single biggest predictor of bank failures in 2009, 10, and 11. This is not an insignificant issue. So it's my understanding that some of the regulatory bodies were on the same side of the table as FASB. And they happen to be the ones that manage the biggest banks, right? So they have an incentive. But I don't think it was unanimous. I think and so you can look in the instructions. It went back and forth. Cumulative life to date got wiped away in 2023 Q1. Then it's rolling 12. Only what you report in the last 12. And then that got wiped away and it went back to life to date. And then some banks are reporting something. And so we were having to teach our clients, look, if the bank is an OCC bank and you see that they're delinquent, you see that their modifications disappeared, it's probably fake. It's probably a reporting issue. But there's no way to track it, right? And there's no honest reporting anywhere. But it's my understanding that there was some disagreement on this that went around for a couple of years. And apparently it was just resolved July 11th. The FDIC sent out what's called a financial institution letter. And I provide a link on it there that basically says, hey, look, and it's one of the shortest fill. A financial institution letter is a fill. It's one of the shortest fills I've ever seen. Basically, hey, moving forward in 12/31 call report 2025, so this quarter 4, you only have to now report rolling 12. And by the way, you can actually start reporting it in Q3, so party on. So we were starting to get honest reporting about how delinquencies are coming down, but they don't want to show that. So what we do is we change the rules so that there's no way to know. And the worst case scenario is it does allow, I have point blank asked several policymakers, and when I say policymakers, I mean regulators across the three, hey, can Bill Moreland just get his payment lowered again if I have a problem as soon as I get off the Ferris wheel? And they're like, there's nothing in the reporting as it is now to keep that from happening. So when you see great delinquencies continue to happen and the trend turn down and, hey, commercial real estate was hideous, but now it's getting better, green shoots, understand what's happening behind the scenes is it's an illusion. You live in a Potemkin village and it's getting bigger, and we change the rules to make it to where we can't see the edge of the village anymore. We really honestly don't know where that line is. It's been so blurred.
We live in a credit Potemkin village.
Correct. Yeah.
Meaning the delinquencies you see are not accurate, and even the modifications you see are not accurate because the rules have been changed.
Fake. Completely fake. Yes.
Breakthroughs begin with semiconductors. With over $23 billion in assets under management, the VanEck Semiconductor ETF, ticker SMH, is not only the largest semiconductor ETF, but it has also outperformed the next largest semiconductor ETF. It is built on an intelligently designed and constrained index that includes the whole sector stack from design to manufacturing. Historically, this unique construction and methodology has helped SMH outperform its closest ETF competitor. Check out the table below. Go to vaneck.com/SMHJack to learn more. Using a similar philosophy, the VanEck Fabless Semiconductor ETF, ticker SMHX, goes even deeper, exclusively investing in fabless semiconductor innovators designing AI infrastructure behind the scenes. We're talking high bandwidth memory, power management chips, custom accelerators, and ultra-fast interconnects, the critical components that make large AI models run faster, smarter, and more efficiently. Go to vaneck.com/SMHXJack to learn more. And now back to the interview.
So what started happening in, so this all goes back to these things, these credit problems don't just happen, right? Just like the Silicon Valley Bank led liquidity problems, but it wasn't just Silicon Valley Bank. There were several problems that had this. And I think there's probably a few banks that didn't pass the stress test because you can see what their actions were in the call report. And it's like, yeah, there's no way in hell that bank passed the stress test. But we're not going to say that, right? You realize that all the vested parties have to know what's going on. If our tiny little company, but you know, we're small, but we've got a lot of clients, and our clients are pretty well connected. When they can see what's going on, and you start to see that, hey, Silicon Valley Bank was technically bankrupt a year before they went down in 2023 Q1. They were bankrupt in mid 2022, and about 40% of the banks were bankrupt at that point in time. But we don't talk about that, right?
Insolvent if you accurately account for
Correct.
their securities and their held to maturity securities based on the interest rate losses.
Yeah.
They would argue, though, that if you factor in their liabilities are also worth less because they're paying 1% when interest rates are at 5%. Bill, so I've covered Silicon Valley Bank and the duration issues at the heart of the banking system like so much on this show, and I think it is quite transparent. Like, yeah, they bought mortgage-backed securities yielding 150 basis points, and Fed funds was at its peak 540 basis points, and now lower. Like, I think those issues are largely behind the banking system. I want to talk about credit. I want to talk about the commercial real estate, the credit card loans, all of the very large line items in the American banking system that indicate lower delinquencies and lower charge-off. So you're like, talk to me about some examples about how this is a credit Potemkin village. We could talk about Bank of America's commercial real estate modifications. We could talk about Discover's credit card. You walk us through, and I'll put some charts on the screen for us through your service BankRegData.
Yeah. So the first thing to understand is these happen in waves. And I'm adopted Texan, although we're not in Texas, but we'll get back at some point. And so you live in Houston, you think of hurricanes, right? And there's storms coming into the Gulf that are going to start hitting, and some of them hit, some of them come close. And so the credit issues didn't all happen in at once, right? And once again, the driver of this was $5 trillion of new money at the end of 2019 to 2022 Q4. So $5 trillion, 38% more money showed up in the banking system. And how that money was utilized, because banks have to put it to work to generate interest income. Otherwise, as interest rates go up and they started. So basically banks did one of two things. They bought securities or they lent. The banks that started to lend aggressively in commercial real estate had the biggest problems, and the consumer lending that took place. But the consumer was fake during this time, right? And I'm a credit guy. I build models. That's what I did for 13 years. And I did it in consumer portfolios, business, but mostly consumer. If you stop making rent payments and you stop making mortgage payments and you stop making student loan payments, what do you think you're going to have as discretionary income? It's going to go up.
Yeah.
So in 2020 and 2021, discretionary income for the consumer went way up. Well, what did they do? Well, the prudent ones went out and started paying down credit card, and they started paying down auto loans. So all of a sudden we had a consumer that looked really good.
Extremely strong. Yeah, and you say fake. I think there
Fake.
definitely was an exogenous event, but it was really
Fake.
strong because of an exogenous event that if you
It's
don't
fake.
have to pay
Yeah, it's
rent,
fake.
yeah,
And
and
so
you're getting checks from the government, you're going to be extremely strong.
yeah, and that's just part of it. And so look, I see the world, I see the world through the data. Not making payments on student loans, what it is economic. Do you know we fill people up full of debt? That's what I did. My job was to find ways to give Jack more money so that he keeps generating more interest income for my bank. And that's great. But what you try to do as a risk manager is fill Jack all the way up to the capacity that he can absorb, and that no more. No more. If you go too far, then you have to lower payments, right? And so that's why this all works. So what
Although,
happened
Bill,
was
isn't U.S. household debt quite low as a percentage of disposable income or its percentage of GDP?
it's going to be on my purview of commenting on. I can flat out tell you, it's to a point where people can't pay it anymore. And so when you see credit card delinquencies go through the roof, they can't pay it. When you start to see portfolios like home equity loans, go into your local bank about a year ago, and now you start to see on the board, hey, talk to us about a HELOC, home equity line of credit. For 54 quarters, that portfolio shrunk and shrunk and shrunk and shrunk as the economy expanded and jobs got really plentiful. And right, people didn't need to tap into their home equity to get a line of credit. But that inverted like 9 quarters ago. Same thing with juniors, 1 to 4 family junior liens, a second mortgage. Those inverted and started to climb. So those are counter cyclical. So when we had all that money pump into 2023, a lot of is the echo. It went into loans in 2022 and 2023. So the consumer and the CRE, commercial real estate, were the first two storms, right? Getting back to that analogy, the first 2 storms we could see coming in were like, oh man, commercial real estate delinquencies are higher, quicker, doubling faster than they did in 2008 and 9. And I overlaid the two and I showed them, it's like, dude, this storm coming in is
all right, Bill, let's talk about the data. I mean, you are Mr. Data. You're the principal of a company called BankRegData. You have the data, but I'll tell you, as someone who looks through all these banks, U.S. Bank, I'm like, their commercial real estate losses are literally negative. Like
amazing.
What you refer to the data that I looked at. You referred to that as basically like a press release, which I guess technically it is in some instances. Or
you want to take a look at Bank of America?
Yeah, let's look at Bank of America.
Yeah, basically what we're looking at here is this was the second largest commercial real estate non-owner occupied lender in America. And what non-owner occupied is the FDIC, the call reports, the FFIEC, they basically make a delineation between non-owner occupied and owner occupied. Both are commercial real estate, but non-owner basically means the debt, the loan is being repaid with rental income. Owner occupied means it's being paid back from business proceeds. So what we're looking at here is primarily commercial real estate that is developed in the loans out there, and it's being paid back through rental income. So if you take a look at the NPL chart, so just to the left of that mods, right there on that NPL, let's lay the groundwork. So scroll down a little bit where we can get, there you go, right there, perfect. So in that first chart at the top, that's that blue brickish, notice how we go from 275 million, 286 million, up to 2.25 billion. Now, every bank in America, every large bank, Wells, JPMorgan, Key, PNC, Fifth Third, they all look exactly like this. And that second data element where all the red is, if you look at the table to the left, you can see that they went from non-performing loans, went from 78 basis points, 79 basis points, And notice how they skyrocket within a year to 4.88, 5.78. But then you notice that it's just kind of capping out. And if you squint real hard in 2024 Q4, which is that $2.02 billion figure, that third from the right data point in the blue chart, you squint, it looks like it's starting to get better. And so basically, this is the green shoots. And now you see the percentage is coming down. So we've gone from 5.78, 5.79, 5.73, 5.21, green shoot. Notice how the delinquencies go from 2.1 to 2.0 to 1.9 to 1.775. This is great news. So this is Wells, this is JPMorgan, this is every single big commercial real estate lender. So scroll back up to the top and click on the mods. So that modification right there. It's fake. What is happening during the same time the delinquencies are going through the roof is banks, the biggest banks, were just starting to modify an enormous amount of their loan portfolio. So you can see that from 2023 Q1, and we can come back to that data point because that's the new rule. That's the rule where you only get on the Ferris wheel for 12 months. Once you make the payments for 12 months, you can get off the Ferris wheel. And you see that in 24 Q2. See how the number drops from 2.03 billion to 1.67 billion? That's not because the people are the borrowers with the reduced payment are paid off or sold or charged off. That means it's a reporting. So it's a reporting. It's fake.
It's a 12-month thing. So they changed the window of, it used
Correct.
to be if you were modified, you were always modified.
Correct.
But now if you've been making payments for 12 months, you're
Correct.
suddenly non-modified.
The last real reporting figure you have on this table is the second row of content. You'll see 2022 Q4 with 36.059 billion of non-owner, 512 million of loan mods. So at that point in time, they had modified 1.42% of their book of commercial real estate non-owner. And then you see the number in 2023 Q1 drop 300 million to 209 and drop 0.58, right? So we lost 90 basis points of loan modifications. No, we didn't. It's a reporting change. They're still on the book. Those $300 million, we're probably upwards of 600 million in 23 Q1. But then you see the Ferris wheel start to get loaded back up, right? 210 million, 462, 1.21, 1.8, 2.03, and then boom, it dips. So what was happening here is they modified, and look at the percentage. The percentage went from 58 basis points to 133 to 3.58 to 4. We're up to 8.5% of their book. So
8.5% of their non-owner commercial real estate loans
had
are
payments
modified,
lower.
not of their total loans, of their of this specific class.
Yeah. So where this really becomes the most obvious to look at is in the upper right. You can see a table with a bunch of blue links. Loan amount 34.09 billion. Delinquencies 1.8 billion. So that's what they're reporting, which for a delinquency rate of 5.34. But remember, that number is starting to come down. But we've modified $2.9 billion. 1.9 billion of that is what we call extend and pretend. The 949 is put on non-accrual. Non-accrual means that the bank is no longer recognizing interest and fee income on the borrower because the likelihood of paying back is very low. So why recognize fee and interest income? Try to get principal pay down. So typically a bank is supposed to be putting 80-90% of their loan modifications on non-accrual. But when times get stressed, the regulators look the other way. And so to their credit, they put 30% on, but that's fake too. Because if you're taking people off of the Ferris wheel, they're coming off the 1.968 part of the Ferris wheel, which means what's left on the Ferris wheel across time will progressively get worse, right? Because as more people start getting off, but the problem is what you're looking at there is we have $1.96 billion of extend and pretend that's bigger than the actual delinquency. So if you scroll up a little bit to the green chart or the green menu, on that far right on that sub menu, you'll see portfolio stress, delinquency, and performing mods. So this is a bank reg data metric. And what this is we say, look, if you can manipulate delinquencies by just doing more modifications, and performing is a misnomer. Performing means we've lowered Bill Moreland's payment and he's making the payment. But read it as lowered payment to avoid delinquency. But the regulators, the policymakers call that performing modifications. It's 11% of their book. So as you modify a greater and greater percent of your portfolio, you're going to eventually start to have the delinquency portion. So go back to total DELC or NPLs. Total DELC is going to include 30 to, and that's on that chart where it says mods just to the left
Total
of
delc,
it.
total delc, yeah.
Yeah. So magically, there's your green shoots. There's your delinquency starting to come down.
And again, for people watching this on YouTube with the chart, this is total delinquent loans of CRE non-owner as a percentage of total CRE non-owner, not as a percentage of total loans.
No, it's just it's just each of their portfolios. So if you scroll down a little bit, you'll see the rest of their portfolios, right? And so there's your book that's all other C&I, and you basically can start cycling through. And so this is the one that's got their biggest problems. Although you do see that real estate and foreign offices looks to have a problem at 8.49%. But it's a smaller portfolio, but it's pretty big delinquencies. But every big bank, scroll up, if you will, and you're going to see a box in the upper right. Put in WFC.
Wells Fargo, where you used to work?
Yes. So you see the same. This is the largest lender. You see the same delinquency table. Now go to mods and you see the same thing. So magically, every big bank with a commercial real estate portfolio all had the exact same thing happen at the same time. Their delinquencies are going through the roof. Now, if you click on the review button on the far left on that, so we had the mods, click on review. Does it look like Wells Fargo wants to grow their commercial real estate portfolio?
No, their CRE non-owner occupied is shrinking.
Now, it may have inverted, maybe, right? If we look at that chart, maybe in 25 Q2, it did. So what you've got going on is every big bank is getting out of commercial real estate lending. Every big bank had huge delinquencies, and every big bank modified them. All these things happened at the exact same time, almost like they're working on the same playbook. So go to delinquencies and click on JPMorgan.
Total delinquencies?
Yeah, total delinquencies right there. Go up to the search box and put in JPMorgan Chase. This is the third largest. Woo, doggy, look at this. So they were not as bad. Everyone else is peaking out at 6. They peaked out at 4. But go to loan mods. Once again, same story.
Ooh.
So at the exact same time, every single bank started to modify a greater and greater percentage. So delinquencies all started climbing. And remember, this all happened in 2023. So they were getting ahead of this problem by starting to change the rules on loan mods. But what happened was there was some disagreement between the regulatory bodies, the OCC, Fed, and the FDIC about what was supposed to be reported. And that resulted in some banks report. And so you can see, look at the 24 Q2 figure where it drops from 150 to 129 billion. It didn't drop. That's people getting off the Ferris wheel. But then the regulatory bodies, the FDIC specifically, started to say, no. You need to report cumulative. You can't we allowed everybody to get off the Ferris wheel in 23 Q1. That's why it went from 51 to 0. But once you're back on the Ferris wheel, you can never get off. So you notice how the number skyrockets from 129 to 265. The 129 number is fake. It's probably 185 to 210. But that's how the reporting went back and forth, back and forth, back and forth. But this is what we talked about at the very beginning. They changed the definition it's now permanent. There will no longer be a cumulative life to date performing TDR reporting as of 2025 Q4. And many banks will start doing it in Q3. And by the way, many banks are already doing it. So,
and is there going to be any way to track that whatsoever?
No, 0.
No.
Yeah. So if you'll do me a favor, what I would like to do is let's see if that's just the only portfolio, right? Maybe commercial real estate's the only portfolio where this has happened. So bring up Discover and sell D11. So the Discover card portfolio,
Discover.
DFS, loans 2012. Now Discover's gone, right? They're
Yep.
gone.
With
And
Capital One. Yep.
I'm somewhat convinced that was perhaps a shotgun marriage, but I think I'm very much in the minority on that decision. But Discover, I think, was not doing so well.
Okay,
Um,
and Bill, I want to say, so commercial real estate loans, and you obviously know the data, so what I'm going to say is true. And if you correct me, then I'm going to go with you. But I think what I say is true, which is you're correct. Wells Fargo is the largest, definitely one of the largest commercial real estate bank lender in the United States. However, there it is definitely not the top most concentrated CRE lender, and I just actually had in front of me the percentage. It was a single digit percentage of their loans are non-owner CRE loans. Like there are regional banks that you would have heard of, but many people would not have heard of unless they happen to live in that region, whose CRE lending as a percentage of their total loans is 30, 40, 50, or even higher percentage. So Wells Fargo, like all of those loan mods could go to zero, and Wells Fargo would still be a solvent institution. And likewise with JPMorgan, we're talking about, a billion here, a billion there. Like JPMorgan's net earnings on an annualized basis are like $56 billion. So it is somewhat of a drop in the bucket if it's just CRE for big banks. However, we're now going on to credit cards, which is a huge percentage of loans for particularly like JPMorgan and Discover and Capital One and the like.
Yeah, I mean, there's certainly no doubt. I think the CRE concentration ratio in the popular press, it's easy to criticize small community banks or mid-sized community banks that don't advertise with you. I had several people in the press, and they're all names you would recognize, periodicals, news organizations on cable. They don't want to talk about what's going on in JP Morgan Wells. We'll come back to some of that. But yes, if you would go to essentially card mods, correct. So Discover's gone. But if you look at this, it's almost the exact same chart. So go to NPLs, and basically there's the
Performing
same.
loans.
Yeah, there's the same story, right? It looks just like CRE. So those were the two storms coming in at the same time. Delinquency started to climb. Everyone started to panic. We changed the rules on loan mods, click back on mods, and that's it. So the 1.8 billion to 631 million drop in 23 Q1 was changing the rules, right? So really, whatever we're sitting at 5.4 billion, you have to add 1.2 billion to that. We're really at 6.6, 6.7 billion. But even with the 12 months life to date, so this is 5.5% of the credit card portfolio it discovered had payments lowered. If you scroll back up and look at the table to the upper right, you will see that the modified is 5.415. So maybe if you'd highlight that for the viewers, 5.415 in that upper right modified. Notice how 16% of it is delinquent. So 425 is 30 to 89 days past due accruing interest. 406 million is at least 3 to 4 months past due accruing interest, and 15 million is not accruing interest at all. So what they modified was 5.4 billion. 16% of it, nearly 16%, was already delinquent again. So if you can just keep modifying and lowering payments, you can manage your delinquency numbers. Pull up Sally. So go to just Sally Mae, SALLIE, and once again, loans 2012 when it pops up. This is a monoline lender, right? So loans 2012. Now go down, and so scroll down a little bit till you get to individual others. That's going to be their student loans. Now those are guaranteed, I believe. Click on mods. And so what this is 7% of the student loans at Sally have basically been modified. And the delinquency rate in the upper right, 1.557 billion. Notice how 83% of it is paying, but 16% is delinquent. So you're running 16% delinquents on people who've had their payment lowered and they still can't make it. So pull up TFC, Truist, put in TFC and scroll down, go to auto loans. Scroll down a little bit more, 5.5% have been modified. And as it starts to taper off, 137, 144, 144, understand there's people getting off the Ferris wheel. So those numbers aren't real. And if you look at the upper right, 23% delinquent or on non-accrual. So what Truist is modified is what percent of their book? Scroll back down, 5.5. Yeah, 5.18. So we've lowered payments. So we've gone from 4 years on a car payment, right? A loan to 5 years, to 6 years, to 7, to 8. And now we're lowering those 8 years.
So 5.18% of their auto loans are on modification. That
Correct.
sounds like a lot, but only 1.49% of their total loans are modified because they also have commercial and industrial. They have CRE. They have construction loans and the like.
Skip on multifamily. You'll see multifamily right above it.
5.52, but they only have $5 billion of loans, which, relative to $319 billion of total loans. So
yeah, but 70 billion of that's 1 to 4, and that's the government dime. So this is where you have to be careful talking about concentration.
okay,
The all other loans, click on the all other loans.
what is all other loans?
What is this all other category? All right, now click on states. No, first of all, notice how the numbers skyrocketed from 50 to 57 to 63 to 70 billion. So click on, so this is a catch-all. 13 billion of it is money to your local governments, right? Cities and states. Click on non-depository financial institutions.
Wait, shouldn't a municipal bond be classified
It's not
as
a bond.
security?
It's a loan.
Okay, interesting.
It's different. So those don't count. 5% of their book is loans to local government. So this is where you have to be careful saying, and I'm with you 100%. And this is what the common is, well, yeah, but CRE only makes up X or C&I only makes up Y. But dude, so much of their loan book is fake. Click on non-depository financial institutions.
Okay.
Click on that bad boy. 35 billion. Well, what is that? Well, if you scroll down, you'll see their components. Mortgage credit is 3.5 billion. Business credit is 20 billion.
So these are all other loans, which is a category for Truist. There's state municipal, which is not municipal bond. It's loans to states and municipal bonds.
Correct.
I didn't know that was such a big market. So thank
It
you
is.
for that. The non-depository financial institutions, we will suspend that, but we'll get to it in a moment. But
Correct.
would that be like a loan to a private credit fund?
Well, yeah, and that's part of it.
And
And
what's purchase carry securities? What are we looking at here?
so you have rich customers that are cash poor. I mean, they're not poor, but their assets are all tied up in something else, right? Non-liquid assets, but they're very wealthy. So they got stock, they got homes, they got commercial real estate, they got businesses, but they want to go out and buy treasuries. How do they do it? Well, they go to Truist and they borrow $6.4 billion to speculate in the securities market. So why is everybody all of a sudden wanting to get purchase carry? These are loans to rich individuals that want to go out and buy treasuries or mortgage-backed securities because they're speculating.
What about equities, or is it just treasuries, mortgage?
My belief it's securities. I don't believe it's equity securities, but I can't definitively answer. That would be even more alarming. My understanding was this was treasuries, munis. So, go ahead and click in JPMorgan. Put in bank name. Yeah,
it's true. This is huge. JPMorgan, so in their purchase/carrying securities in 2023, the second quarter, it was $13 billion, and now it's $127 billion. So that's a huge increase.
Correct. So basically, dude, 9.5% of JPMorgan's entire loan book is lending. And I'm not saying that this is not a good risk-adjusted loan for them, but this is not what you would consider benefiting Main Street, right? This is not
but it's not if it's not a systemic risk. And I think like lending to a hedge fund that's doing a carry trade, maybe it is helping society, maybe it's not helping society. But I'm just saying that it's like generally hedge funds tend to pay their loans back, and when hedge funds don't pay their loans back, it's in the news.
Sort of like AIG was able to pay all their insurance claims in 2009.
Well, because they got taken over by the government.
No, because they failed. So we can say that there's no risk. There's always risk. The question is our banks setting aside enough reserves but we're talking about levels we've never seen before. Go to NDFIs, non-depository financial institution.
Yeah. This is big. So describe what so these are loans and it says components of non-depository financial institutions, mortgage credit, business credit, consumer credit, but it's not actually lending to a mortgage, a business, a consumer. If they were, they wouldn't call a non-depository financial institution. They're lending to a non-depository financial institution who is then making loans to these people. So is it like kind of like a warehouse line type thing?
It's going to be all the above.
Yeah.
And I'm going to give you some good examples, and I'm going to give you some really, that's what's in there. So yes, notice how the mortgage credit one. So banks don't want to lend anymore in mortgages. They don't, but they can basically wholesale and fund. And I'm not going to say Rocket, but that's the most common one, right? Rocket Mortgage goes out and does all the mortgages. They underwrite a bunch of them. Well, they have to get the funding from somewhere. And I suspect they got much more sophisticated, but there's a lot of other intermediaries. So mortgage credit will essentially be funding mortgages. Business credit could essentially be, for example, you got a small business lender that wants to do receivables backed, right? So there's a number of these guys. One's in Atlanta. They basically do lending to BankRegData. Children's Lane Partners is our corporate structure. I need money. They basically lend to me, and it's backed against my accounts payable, right? And so that's the collateral. Well, they want to grow. So instead of Wells going out or JPMorgan going out and lending to those people, they can just basically lend to those intermediaries. So they're competitors. But the beauty of this is, are we sure they have to hold as much reserves and capital against these loans, or is the risk weighting different? So some of these are legitimate businesses, but I would tell you from a risk perspective, what happens if you're disassociating the risk decision from the bank to the business intermediary? What happens if the business intermediary risk manager leaves and the person that replaces them is not that good? Is that loan still as strong, or does it get weaker? So there's that risk. But there's also, and this is a real example, I gave a presentation to a bunch of people that were basically looking for banks that do NDFIs, non-depository fund. And so they get this. They're the borrowers. And they were worried that these halcyon days are going to come to the end, or their bank is going to cap them out, and they need to go get more funding. So I looked up all these guys, and one of them legitimately was Bill's used truck financing. You can't get your used big rig funded through your local bank? Come to Bill's. Bill's will fund your used bank. No credit score needed. Nobody turned down. That's a business credit intermediary. So I worry that we don't really know what these are. But if we go back to commercial real estate, and we go back to how do we manipulate delinquencies? One of them is loan modifications. I think we kind of beat that one into the ground. But one that we haven't talked about is note-on-note financing.
Yes.
So a bank has and this is a real example, by the way, because we have 65, 75 clients that are private equity groups that use BankRegData to prospect for banks that have CRE, C&I, Resi, to buy it off their books. And what happens is an overvaluation problem can't be solved without value destruction. But we got a lot of clever people, right? We're putting our best and brightest into finance for the last 3 decades. So we come up with very creative ways of solving problems. But really all you're doing is financial engineering. But we have $50 million of commercial real estate on our book that we need to sell. So I got 7 loans. So Bill's private equity group basically calls up and says, Jack, I want to buy that off of you. Can we take a look at it? And you go look at it. And that $50 million on the books is really only worth 84 cents on the dollar. And I could kind of make it work at 84. So I'm going to offer you 84 cents on the dollar. A bank says, no way, man. I can't take an $8 million loss on this, right? But here's what we'll do. We'll take a $2 million loss. You put in 10 million, and I'll give you $38 million of note-on-note financing. And so you take $50 million of not so strong CRE that's in delinquency, out of delinquency, in delinquency, out of delinquency, and you sell it to Bill. But you fund 50 million of that through $38 million C&I loan, commercial industrial loan. So that's what I would call loan laundering. You're laundering a bad CRE note off balance sheet, and then you're basically putting back on the balance sheet a $38 million performing C&I loan, but it's non-recourse. So what the bank would argue is, look, we got a $10 million capital buffer. So what we've done is we've changed our loan to value from 100 to 84, right? So there's a buffer. I struggle with this. Is why would you pay 96 cents on the dollar when you think it's only worth 84 cents a dollar? Well, it allows me to buy more with my capital stack. It's like, okay, that makes sense. Plus they have a longer time frame, right? So I get it. There's lots of good ways this could work, but a lot of these deals are non-recourse. So starting about 2.5 years ago, our note buying community, private equity groups, were saying, dude, we can't buy. No one wants to sell. Everything is moving to note on note. And then you start hearing this. And at first it was 70, 30, 80, 20. But then it became 90, 10. So the bank is funding 90%. And it's really 9 out of $10 is still exposed to commercial real estate, but it shows up on C&I. So I started reaching out to the regulators and I'm like, hey man, I'm sure I'm not the only guy seeing this. I'm probably just a voice in the chorus, right? But do you know that they're putting this stuff in? Yeah, C&I. And so there was a big push to move it into non-depository financial institutions reporting. So that's why you see these big run-ups is banks were having to reclassify from commercial and individual other into. So not only was there huge organic growth, there was reclassification growth. But I heard from two separate parties about 9 months ago that JPMorgan Chase was shopping a $300 million note in Chicago. And their negotiating started at 90-10. I'm like, what? So these are clients on the other side. I've got clients that are banks. I got clients that buy it, right? So you can talk to both sides, and I sit in the hub of a wheel and I get educated by each sector of that wheel. Like, they started at 90, non-recourse. And I'm like, okay, but we know that property and we know that that tenant is only 60% occupied. In 2 years, it renegotiates and basically it's not going to be worth anything, right? But we turned it down. JPMorgan came back and said, we'll do 100%. You don't have to put any money in. So JPMorgan Chase balance sheet, JPMorgan Chase basically is offering multiple people 100% note on. So basically we're giving you money to take the stuff off our balance sheet so we don't have to report it.
And this is not a synthetic risk transfer. This is,
well, that's a straight up a note on note financing. So bring up, if you would, let's go see, were they successful? So go to JPMorgan Chase, bring up BankRegData, go back to JPMorgan Chase.
Oh yeah, I got it.
Next to review main, scroll down. Woo, look at all those loans. Look at, woo, delinquencies are getting better. Just ignore the orange chart. Click on CRE non-owner occupied, number 8.
Okay.
By the way, they seem to have a lot of red, right? So scroll down and let's go back and look at owner, non-owner occupied. So the one right above it, non-owner. You see how that number goes from 1.2 billion and it drops 300 million in Q1. Any bets that that was a $300 million loan that got taken off the books?
And recycled into a non-depository financial institution.
Correct.
Okay, yeah,
correct. So when you look at delinquencies going down, know that loan modifications is an enormous game changer on how you manage delinquencies. And we changed the rules to make it like an accelerant, right? We made it that much more powerful. But also understand there is a separate way of doing this, which is just give people money to take the stuff off your balance sheet, non-recourse. So in 2 years, it's entirely possible that that $300 million note will get thrown back over onto JPMorgan's balance sheet in 2027, Q1, Q2.
So to be fair, it is, I guess, to have a dodgy loan on your book or to have a loan to an entity that then owns that dodgy loan, like Ares.
They don't own it. They're renting it.
Okay.
They're renting it. It's
how long are these note-on-note financings?
I don't know. They could be across the board, right? So part of note-on-note financing is Bank A funds a private equity or a private buyer to buy assets off Bank A's balance sheet. And I've asked the FDIC and the regulators, hey, look, the NDFIs are great reporting. I like what we've done. But really what I care about is how much is it loan laundering, right? How much of those non-depository financial institution massive loan growth is banks paying or lending to people to take bad balance sheet assets off their own book temporarily. It's temporarily. Don't think that it's off the book. It's fine. It's non-recourse. It can get put right. And so I asked these clients of ours, how do you make money on this? And like basically JPMorgan Chase lends us $300 million at 3%. We're generating rental income that covers that spread and we make net interest margin. And we use some of that to as profit. Then when it turns sour and it has to get reevaluated back to normal market rates, we just give it back to JPMorgan. And we don't lose anything.
And would these private equity firms or private credit firms, would they, alternative asset managers, would they refer to this as bank capital relief transactions?
They all have names, right?
Yeah,
Synthetic risk transfers. But this is what I'm talking about. Look, there's a lot of very bright people trying to solve an overvaluation problem. The problem is, when have we ever solved an overvaluation problem in an asset class without some asset destruction? So if the asset destruction only comes, but now you see the cleverness of the loan mods. If we just kept dumping inventory and charging it off and repricing what commercial real estate, that property in Chicago that's $300 million is probably only worth 65 cents on the dollar. If you had to reevaluate that market price, every other bank has to now lower, and now the private equity groups are now, right? And so by extending and pretending it, by changing the rules and hiding what we report, not report, and by pushing it off balance sheet, it gives the illusion that things are better. So Bill Moreland, the 27-year-old collection manager at Wells and risk manager, say, there's no way in hell this is going to work, right? I'm more, dude, the Potemkin village just keeps getting bigger. And so I have a lot of bank clients, and I had 2 phone calls about a month ago. Hey, you're very negative. I'm like, I'm not the Pied Piper of doom. I'm just showing you numbers, man. I got kids that are trying to get jobs. I don't want a bad economy. But I also want my kids to be able to afford a house, right? And so we have overvaluation in asset class after asset class after asset class. Eventually, we're going to have value destruction. How do you have value? Well, we don't. We just keep changing the rules and changing how we do things to hide it. And so I've become, here's the curve of skepticism. No way in the world. Oh yeah, everything's great. Everything's awesome. I'm moving maybe a little bit more. Hey, I'm getting phone calls from chief risk officers and chief lending officers of 10, 12, $15 billion, very strong community banks. Go do business with your community bank. Do it. They're great. They're well run, not everyone, but there's a knock. It's the large banks that morph the rules. It isn't your local community bank. Your local community bank is going to probably be not problematic. But these community banks are saying, hey, commercial real estate's looking great. And I'm like, dude, are you aware of note-on-note financing? Are you aware of the loan modification rules? So when you look in your local markets, when they use BankRegData to get local market peers, they look at what their performance. Hey, Bill, all the guys that we do competition with in our local market, their CRE delinquencies are going down. We're thinking about lending more. No, this may work. Then you start coming to the realization it's the perception. It's the concept of wealth impact, right? If everyone thinks they're wealthy because their 401's up and their house is way up, they spend more. So if we can provide banks with that illusion, hey, delinquencies are starting to look pretty good, you should start lending more. Does it become self-fulfilling? Maybe. I'm not as dogmatic, and no way is this going to happen. I'm moving a little bit left, but I honestly believe that all we're doing is stretching out that runway. We should be in a recession. We should be. But if you just lower payments on enough people and you keep lending and pumping money into the economy, you can keep going on with the illusion. Liquidity raises all asset valuations. And that's the banks are now pushing this, right?
And Bill, so what does the modification cycle or modification rates normally look like in the 80s, 90s, 2000s, 2010s? How frequent was the use of modifications in terms of a rough percentage, and what does it compare to now?
Way lower. I mean, if you go back, we were looking at the commercial real estate portfolio of the non-owner portfolio of Bank of America, and it was like 8.5%. And there was that black chart that showed it for the last 10 years. 8.5 was like 9 times bigger than it's ever been before. It's being used at unprecedented levels. Did we have loan modifications in 9, 10, and 11? Yeah, we did. But we weren't doing them this fast. It's part of the Texas ratio. So if you would pull up that spreadsheet, you'll see a chart down at the very bottom called TDR and failures. Why do I keep pounding this table, right? And so on that,
I don't see that.
on the very bottom.
Oh, yeah. Okay. Yeah.
So share that document. So this was like about 9 months ago. I put this out there. So performing TDR is a misnomer. But what this is 2009 Q1 performing as a percent of your total loan book. So this is what it was right when we first started to, and you don't just have a cliff, right? The cliff is leading up in 8, Q1, 08, Q2. But if we just put a line in the sand at the beginning of, 2009 Q1, what percent of your loan book has been modified and left off non-accrual? Now, the way a modification, and I use TDR, and your older audience, that's George Carlin fans, would recognize this. We no longer call it shell shock, right? Yeah. It's PTSD, and it just keeps changing to less meaningful words that are longer descriptions. TDR is troubled debt restructuring. It's very clear what it is: troubled debt restructuring. Up until 2023 Q1, that's what it was called. Then in 2023 Q1, when we changed the rules and we set it some CECL things, and we put a lot of window dressing on it, but we changed it to no longer have to report the big Ferris wheel, only rolling 12. But we also called it loan modifications to borrowers experiencing financial distress.
And this was in 2012?
2023 Q1. So I'm looking back. So when you modify a loan, you're supposed to put it on non-accrual, which means you're not recognizing fee and interest income. The problem is when you put it on non-accrual, it gets stained with the scarlet letter of TDR non-performing. So banks don't want to do that. So what they do is they lower the payment to BankRegData from $10,000 a month to $7,000. And then Bill makes his $7,000 payment, and that's considered performing. So it's making payments at a lower payment obligation.
So it's considered performing, and it's considered not delinquent.
Correct. Yes. So these are the good ones, right? So how, and what I tell people is, look, this is a gateway drug. So a little bit of it. So you see there were 4,940 financial institutions that had none, that had zero. They weren't doing any modifications. 3 years later, 392 of them were gone. Now, what gone is we don't know failures. Oh, well, Bill, there are failures. No, there aren't. Some banks failed. But what happened real quickly, and I'm old enough to remember and paying attention during this time, we stopped doing Failure Friday. So every Friday at 5 o'clock, the FDIC would release, here's how many banks failed. And the market would open up 400, 500, 600 points down if that number was big on Monday. That was back when 400 or 500 was enormous. Now that's just a rounding error, right? So what happened was we stopped doing Failure Friday. We started doing shotgun marriages, and then we started doing proactive shotgun marriages. So what I've measured here is how many banks existed 3 years later. So 92% of zero modification banks still were around. So that means 8% were gone. Some of those could have been happy, right? They could have been mergers of good, happy, or cash outs, or families getting out after 3 generations or 5 generations, right? But most of them were bad during this time frame. But you notice how if you do a little bit of performing TDR, it goes down to 6.9%. So this is the medicine. If you manage TDR in a responsible way, you can actually, banks that did it at a low enough level, actually a greater percentage of them survived. Not
Right, and this is
much.
what like Sheila Bair, former FDIC chair, talks about in her book, "Bull by the Horns," I believe, about how actually in 2008 and 2009, I guess this is outside of the banking system mostly, but in mortgage-backed securities and in collateralized debt obligations that held them, the mortgage-backed securities were almost never modifying loans. They were always foreclosing, and if everyone forecloses at the same time, that's a crisis. So yeah, modifying can be a good thing, because if you just let it roll it down, kick the can down the road a little bit, you can get they can pay it back, and you won't cause a huge systemic crisis if you foreclose all at once.
Well, no one views a systemic crisis when we're lending all the money. It's only when you get the price or the payback, right? I agree with that to a certain extent. But if you look, 371 banks were between 1% and 2%, 234 were at 2 to 4. So you're talking 100, 334. You're talking 600, 700 banks were doing quite a bit of loan modifications at this time. So I don't know that I fully agree. I think she's right to a certain extent. But what we're
Yeah,
doing
maybe
now,
she was referring to, I guess, mortgage-backed securities, loans in mortgage-backed securities, and the special servicers. So
possibly,
yeah,
yeah, entirely possible. So what you're seeing here is there is a direct relationship that the more loan modifications a bank does, the more likely they are to fail. So once you go to 1.2%, 1 to 1.99, 17% of the banks fail. Once you go to 2 to 4, 23% of the banks fail. So realistically, this is the single biggest predictor of bank failure. Remember, banks only hold about 1.2 to 1.3% of their loans as reserves. So when you start modifying more than you even have reserved, that doesn't even include delinquencies. So it's directional. It's on big volume, 66 banks and 28% of them, 43%, 42.42% of the banks failed. This is the single best predictor of bank failure proactively. Not like Texas ratio, which is, hey, you stink because you stink. This was proactive. These were people that already had enormous levels of loan mods at the beginning. So where are we at now? They're all drinking Sheila Bair Kool-Aid. Let's just modify everything. But we know that is problematic.
And so, what is the TDR for
troubled debt restructuring? When I say TDR, think loan modification.
Okay, and so yeah, this is the George Carlin. This is the shell shock that's now called modification rate. So, what is the modification rate now? If you said that 42% of banks that had a troubled debt restructuring, aka modification rate of over 5%, like what are the modifications rates now? Like for JPMorgan?
It's hard to say.
Yeah.
So pull up BankRegData and pull up Flagstar.
Yeah. Oh, I will happily.
Who could have saw it coming? I don't know. A lot of people, maybe. Pull up Eagle. I mean, there's a lot of banks that you can look at that are going to be problematic. But yeah, let's go in and let's take a look.
I'm in Flagstar.
There's the big acquisition where they just kept putting them together. Hey, what could ever go bad?
Yep.
Look at the FTE column in the upper left. Notice how the number of FTEs, that's full-time equivalent. Notice how in 23 Q4, there was 8,766 employees. Notice how they're fired 3,000 of them.
Yeah.
So if you basically look at this bank, go to tier 1 capital on the third menu. We are more capitalized than we've ever been. Correct?
Yeah, yes.
13.9%. Now scroll up to that table at the top and take a look at 2023 Q3 at 9.69 billion. Notice how we had 9.7 billion of capital. Notice how that number is gone down almost virtually every quarter.
But risk-weighted assets have gone down by more, and I'm guessing you'll say that that's because the risk weights have gone down, so they've transferred stuff into lower risk.
They're selling stuff left and right.
Yeah,
they're selling seed corn. So go to loans 2012. What they're doing is they're shrinking the balance sheet to give you the illusion that they're more capitalized. Meanwhile, Steve Mnuchin put in 1 billion, 750, 800 million of that has already been burned through. So look at the total delinquencies. they've skyrocketed. And it's not just one portfolio. Click on the NPL. Click on the NPL right above in the middle.
Yeah.
Now, there's wow, it looks like it's starting to peak. All right, so scroll down. Let's just cycle through their portfolios. There's multifamily. And I
Huge
know what you're
multifamily.
going to say. Click on multifamily. So there's their apartment book. And I know everyone's going to give excuses, but dude, these are, whether they're rent controlled or not rent controlled, this still tells you something about the economy. Forget Flagstar. 7.5% of their mortgage, their MFR book is delinquent. Scroll down and go to non-owner occupied. So we'll just start cycling through, or click on non-owner occupied. All right. So that number skyrocketed to 12.6%, and then magically has gotten better.
So should we
So
go to
scroll
mods?
down a little bit more. Yeah, it's incredible. Well, there you go. Oops.
Oh, what happened to mods? Mods?
Where did it all go? We know everything I've been preaching and, standing on the soapbox and screaming. Is that real? And here's the perverse thing about this. Maybe it is real. Maybe they did sell $340 million off their books. Well, then you have to ask did they do note-on-note financing? So there's lots of other questions.
Using BankRegData, can we see note-on-note financing or no?
No. Convenient that. We only know if it's in NDFIs. But
Although
if you look at,
how can we do that? How do we go to?
Before we go into the NDFIs, let me show you how these rules become perverse. And this is where I don't think everybody's really thought this through. I get why everyone's doing it. It's not a bug, it's a feature. They want people to not know. But when guys like me proselytize and say, look, Jack, can you trust that $330 million drop? What happens is you have to say, no, you can't. Because how do you go off of TDR? Do you go off because the note charged off? Do you go off because the guy basically paid his note off? Do you go off because he was sold? And if he was sold and it was a legitimate note sale, that's a great thing. Or did it go off because they changed the rules? And so in a perverse way, you now can't trust the data. So if you can't trust the data, you assume they're lying, right? You're assuming it's not a lie, but it's taking advantage of conveniently changed rules to make it more difficult to really know.
The bad stuff is extremely clear. Like the non-performing loans are very high, and they had skyrocketed, and now they've been like somewhat flat. So
yeah,
I think that the reason maybe we're not seeing as much quote unquote funny business is because like the dirt is out in the open,
Correct. Well, not entirely. Go up to asset quality in that blue menu in the top, right in the middle, underneath main. Asset quality. Now, underneath asset quality on the far right, scroll back up a little bit above that orange chart, click on RES to NPLs. Third menu, right there. This is what's called a coverage ratio. Don't look at allowance levels. What the numerator and denominator are in the chart in the upper left is adjusted NPLs are 3.179 billion. That's going to be adjusted for any government guarantees. So any mortgages that are guaranteed by the taxpayer that are never getting charged off and they just keep getting payments lowered, and this is why your kids can't buy a house, those are taken out. Loss allowance is how much reserves do you have set aside. Notice how in 2024 Q2, they had 1.952 billion of NPLs and 1.268 billion of loss allowance. They had 65 cents of reserves for every dollar of ugliness coming down for potential charge off. So you notice how the number went from 4.8, which is $4.80 of reserves for every dollar, to 3, to 2, to 1.5, to 65, to 45, to 35. This is one, and look at that black and purple chart, 10 years. This bank is not reserved. They're not reserved. So they're burning capital. Their delinquencies look like they may be kind of peaking out, but we can't tell what they're doing with loan modifications because they just all disappeared. But net, you only got 35 cents. And so if you scroll to the very bottom of this page, I'm all about context. So keep scrolling down. There's the 10 banks that are closest to them in asset size. They're number 10. So Western Alliance, which is no paragon of performance, is at 82 cents. Everyone else is above $1. Look at Comerica at $2.41. Look at East West at 565.
Right, but people do know this. Like Flagstar is the worst performing bank over the past
correct
2-3 years.
So so if you scroll down, you'll see that they're gonna be in the bottom. To keep going, this is 100. This is the 100 banks their size nationally. They're 97, and you really can't look at Beal and Deutsche because they buy discounted purchased assets. Yeah. Flagstar is not reserved. Flagstar is burning capital. Flagstar's hiding loan modifications. That's the worst case scenario. Best case scenario, they're managing them. But any way you strike it up, that bank should be sold off. But who's going to buy it?
So, Bill, this is extremely important. Number one, I think it's interesting by its own merit. And I think that investors should be aware of this. Bankers should be aware of this, definitely. And I think I'm glad that to whether institutional people watching or just folks at home, watching this, I'm glad that we can share this message and this information, which is, I didn't know this before talking to you. However, when you talk about like systemic risk, look at like JPMorgan or Bank of America. All of those numbers, I think, in terms of modifications are a very, very small fraction of their earnings or their equity. You're shaking your head.
No way at all.
Okay, so, let's do the numbers. Should we, Bank of America, JPMorgan, or any other big bank? Let's go.
So look, it doesn't matter what their earnings are. If I'm not reserving money, my earnings are going to be great. I can show you a lot of banks that take negative provision. So
yeah, true. You're right. Bank earnings, all financial earnings are somewhat fake in terms of they reflect expectations about the future that could be wildly optimistic or wildly pessimistic, and ultimately, what matters is what is really going to happen in terms of.
Yeah, I think there's a lot of banks that do a great job.
Yeah,
but the problem is if all you do is look at earnings and you don't look at the restructured debt.
Okay, well, let's look at capital then. Should we look at capital?
Well, I just showed you Flagstar's burning capital. Okay, let's look up another one.
JPMorgan, Bank of America, a big one.
Look up Truist.
Okay, Truist. Okay, that's kind of big, kind of.
Yeah, no, well, we look at any bank you want. The biggest banks are going to have plenty of capital, but let's look at the ones. Let's look at Truist. Truist is huge. So pull up Truist.
Got it.
Yeah. And essentially go to tier 1 capital on that third. Now, remember, this is the depository. This is not going to be the holding company where they have lots of other stuff going on. So when you look at tier 1 capital, understand that this is what shows up on the call report is the bank. What deposits are insured, that's this sub-entity, which is the majority, but they can have capital outside. So what you're looking at here is, and once again, in the upper left, quarter risk-weighted assets, tier 1 capital. Look at the 2024 Q1 figure of 48,367. I don't know if you can highlight that with your mouse.
Sure. Yep.
All right. So notice just prior to this, they were sub 10. And they did they went from 40.81 to 45. Well, what did they do? They did a capital raise. Why? Because nobody's at 10. So forget Basel, forget all this. If a bank has a 10 handle, they're told to raise capital. So you can see in 2022 Q4, it went from 40.8 to 45. The number went from 997 to 1059. Then what you see is the number climbs to 47, 48, 48, 48, 367, which you highlighted.
So they issued shares. They issued shares. They raised capital.
I can't speak to that earlier.
I'll look it up. Yeah.
Yeah, it's entirely possible that's what they did. But net, I can see the extra $4.5 billion showed up on the income, right, on the balance sheet. So what you're looking at here is the illusion that things are improving. They're managing the risk-weighted assets by shrinking the book, selling loans, not taking FHLB advances, lowering their cash levels, selling securities. So we go from 9.97 to 1174. But then the number jumps to 52.7 billion, the very next quarter. That was them selling the insurance arm. They raised $10.5 billion by selling another subsidiary off the call report for $10.5 billion. They took $6.5 billion and they threw it in the fireplace by selling securities portfolios and taking $6.5 billion of loss. They took the other $4 billion and raised tier 1 capital. So now the number goes to 52,728. So basically they sold seed corn to get more capital. But notice when banks say they want capital relief, notice how it's gone from 52,728 to 51,440 to 58,98 to 57,690.
They've done buybacks. And Bill, so I looked it up. They actually did not do any share issuance since 2020. They just in 2023 they stopped doing buybacks, so I think they just let the capital accrue. And then
Okay.
you said the thing they sold an insurance arm, so they had
Yep.
some more capital there. And then they started doing more buybacks over the past year. So I think that as capital has gone down, that's because they've been doing buybacks.
Well, I think it's more insidious as well. But notice how the 52.764 has dropped $2 billion in the last year.
Yeah.
Their tier one capital rate has gone from 1311 to 1191. So this bank is going the opposite direction. Go to income and expense in the blue tabs in the upper left. Now down below on that third menu, all the way to the right, you'll see div. Go back up. Third menu, div. Yeah. Keep going up.
Oh, sorry.
Div on the far right. That's going to be dividends. That third menu, far right.
Oh, sorry. Okay, yeah.
Yeah, it's all right. Notice in 2024 Q2, when I said this bank had peaked in tier one capital, notice they're paying out 156, 113, 207, 121, and 120 of dividends. This bank is paying out more dividends than they're generating in income. That's why capital went down.
So their payout ratio was higher than
correct.
And if you include the share buybacks, okay, yeah. So their payout ratio is higher than 100%, meaning they're
correct.
paying more to
so
share.
When big banks tell you we need capital relief, this is what they mean. They want to pay out more in dividends.
Right. And Bill, I do think that banks are incredibly levered institutions by their very nature, and large banks, I think because of Dodd-Frank and other reasons, like they have a GSIB, not that Truist is a GSIB, I don't think, but they have, like, the larger the bank is, the higher the capital ratio they have to have. Like those community banks about whom you spoke so glowingly, they have much lower capital ratios than pretty much every bank we've talked about. And they have a higher percentage of commercial real estate loans. So I feel like
that's not true.
Okay.
Yeah, that's what the press look. If I lend to international entities, that's going to make my loan book bigger. If I go out and do lots of trading, do you remember when JPMorgan lost $6 billion because, quote unquote, a whale fat finger?
Yeah.
We don't talk about a trading concentration risk, but it was 10, 12 years ago. JPMorgan Chase lost $6 billion, and yet that's part of CRE concentration, right? These are all banks. Big banks do so many more things than the local community banks do. Their exposure to commercial real estate is enormous. If you go to, and I'm not trying to be argumentative, what I'm trying to say is,
but Bill, the capital
everybody wants to say
the capital thing I said is true. You acknowledge that, yes? The capital,
what's
that community banks have lower capital ratio than big banks.
Oh, I don't think that's true at all.
Really? Okay.
The problem with that is we don't really know because of the 051 reporter. But I'll bring up tier one leverage. I'll have you do it. Okay. So pull up BankRegData and go to industry. Once again, we can talk data, right? Let's talk data and see what the data says. Go to in the upper right, you'll see an industry tab. Every ratio you can get at an individual bank level, you can get aggregated today together for the industry.
I clicked
so we can look at the tier one leverage ratio by asset size.
Sure. Okay.
Yeah.
Okay, so this shows the larger banks having a smaller tier one leverage ratio. So it shows that I'm wrong and you're right. But what about the GSIB surcharge, though? That I thought banks have to have higher capital.
I can't speak to that. I can tell you, look, publicly traded banks want to be tech stocks. Yep. They've always wanted to be. And the bigger they are, the more they want to be. So whatever metric you look at, how much provision they're setting aside, what's their coverage ratio, how much loan modifications, there is always a very clear divide of publicly traded bank and privately held bank. A publicly traded bank is always going to show higher earnings by managing and keeping all their other ratios low. So they don't set aside enough reserves. They don't have enough provision filling that reserves. They're doing a lot more loan modifications. And so what ends up happening, and they're doing a lot more NDFI reporting. That doesn't mean they have to. So NDFIs, and I would suggest check with an expert on this because I'm not that guy, but I've heard They don't have to hold as much reserves and capital against non-depository financial institution loans. So what ends up happening is you're encouraged as a bank to do more of those lendings. Well, who sets
Yeah.
those rules? The big banks. They lobby
Yeah.
for them, right?
Okay. So this is tier one capital. What about risk weighted? Is tier one risk weighted?
Risk-weighted capital is basically the denominator. The problem is I'm showing you tier one leverage because it's the only thing that's universally reported. Back under
Yeah.
Trump 1.0, there was a big deregulatory push and call reports got whacked. And in the beginning, it made a lot of sense. But then they started getting into the muscle and then they started getting into the bone. One of the ones they got rid of is for about 3,000 small community banks, they don't report schedule RCR2, which is capital. And the reason is because the regulators wanted to hit their annual goal of deregulatory burden, and they'd already cut a bunch of stuff. And they said, look, if we just get rid of risk weighted assets for all the small community banks, we can reduce their regulatory burden. So the problem is tier one capital divided by risk weighted assets completely got screwed up because you can't do big bank, small bank comparisons anymore because not all the majority of small banks are what's called community bank leverage ratio. The only number that's universally reported is average assets for leverage purposes. But if you go back to before the 051 call report implementation, 2018, 2019, the smaller banks are always more capitalized than the biggest banks, always, because they're privately held, dude. Dad started, great grandpa started the bank, right? And you have to understand, I manage my business different than if a private equity group managed my business, how I
So,
treat my customers.
So totally tier one leverage, which doesn't take into account risk weighting. You're completely right. But tier one capital banks that
But
have
tier
more.
one capital is relative to the asset size. You can't compare the dollar amount. Any way you stack it up, community banks are more capitalized than the biggest
Okay,
bank.
community banks, but like banks with 50 to 99 billion dollars have a lower tier one capital ratio than 100 to 99 billion and over a trillion. So I guess that's what I was referring to. But yeah, you're right.
Yeah.
Community banks, the smallest banks have the highest capital ratios. I stand corrected. You are correct.
Yeah, no, there's no doubt. And please understand,
Yeah.
you can show like it's the illusion. Flagstar shows that they're more capitalized than they've ever been, but they're
Yeah.
not. They're managing their assets and loans and cash. They're strip mining the assets and getting them off their book. And how they're doing that is they're selling seed corn. They're not selling the delinquent loans. Otherwise, they'd be taking big losses on the value, right? And you can see loan sales, non-interest income, and it's not negative.
Yeah.
So what they're doing is the bigger banks, and they all started doing this. Key, Truist, Flagstar, they all started raising and manipulating. One, they were raising capital, or two, they were manipulating the denominator and selling off seed corn to shrink the risk-weighted assets so that they could say, hey, you can go back and look at Silicon Valley Bank. They were one of the most tier one capital banks in the country. But it's fake.
Could you summarize your views on the banks?
I'm walking through every single segment of the economy, construction, apartments, residential, right? And I'm showing you how the largest banks are the monoline lenders, like Sallie Mae is a monoline lender. They're just manipulating the shit out of the data. So the question is will it work? And I don't know. I used to say no way. But if enough people, and I mean banks, chief risk officers, and lending officers think that things are getting better, can it have the same impact as the wealth effect? But I'll still come back to it. Is commercial real estate in 4 years going to be worth what it's worth now, or still going to be worth less, right? How long do you have to keep the charade going before we grow back into the real asset, the on the books asset valuations? And if they can thread the needle and thread several of those needles, they may. But I'm kind of under the opinion there's going to be an exogenous impact there will be a bank or two that will stumble. But yeah, it's starting to look great, man. Party on.
Yeah, you've really opened my eyes, Bill. And I think that you can think of this as kind of a credit easing if you basically make delinquencies
Correct.
disappear.
It's a great way to look at it.
I'm optimistic, Bill. I want people to have jobs too. I don't want there to be a recession. So I'm optimistic we can kind of kick the can down the road, but it does seem a little bit ominous. I will note, Bill, maybe I'd love to have you back on, maybe this year or next, but we could talk about this next time. Is you said what is real is net interest income, and if all these loans are getting modified and they're getting lower interest, that would be reflected in net interest spread. So, the fact that net interest margins are still relatively healthy, I guess they have not been as strong as I would have thought. And I guess now what you're saying is a reason for why. But I think like if every loan was modified and it was a total zombie loan, banks would have like very crappy net interest margins, and many of them don't. But we'll leave it there. Bill, thank you so much for coming on Monetary Matters. People can find you on bankregdata.com. You're a hard man to track down, but if there are institutional investors involved who listening who want to learn more about your research, I mean, here's the thing: whether I agree with your conclusion or not, your platform is amazing and extremely useful. And if I was an institutional investor investing in banks, which I probably would be if I was an institutional investor, I would definitely use your service. And I'll also say that, yeah, I really like the crossover. One other conclusion to draw is just that the large amounts of banks' exposure to non-depository financial institutions. I think, Bill, a lot of we talked about funny business in the banking system. I think a lot of the aggressive risk taking has migrated outside of the banking
Correct.
system. I read a Bloomberg article about Apollo basically issuing a bond to itself, where the bond is collateralized by all of these more risky loans, and like Apollo probably can get away with it, but they're going to be copycats who are not as smart as Apollo, and that could cause another financial crisis. Who knows? But Bill, we will leave it there. Thank you so much. Thank you everyone to watching. A reminder to leave a rating and review on Monetary Matters and subscribe to the Monetary Matters YouTube channel. Until next time.
Thank you, Jack.
Thanks for tuning in. Looking into SMH or SMHX? Head to vaneck.com/SMHJack and vaneck.com/SMHXJack to learn more. Until next time.
Thank you. Just close the door.